Silver's rally might not be over yet, as the supply shortage is about to get more serious, with China putting restrictions on exports from 2026. As per some reports, Beijing has announced that Chinese companies will need special licenses to export silver starting January 1, 2026, with the policy set to remain in force through 2027. The move comes at a time when the global silver market is already running a multi-year supply deficit, raising fears of further tightening and higher prices. China is the world's second largest silver miner and a critical supplier to global markets. Industry estimates suggest that 60 to 70% of China's silver output find its way overseas. Under the new policy, only large and state-approved firms producing at least 80 tons annually will qualify for export licenses, effectively shutting out smaller exporters. Trade experts say the policy is aimed at protecting national resources and ensuring sufficient availability for domestic industries such as solar panels and electronics. However, analysts also see a strategic angle, similar to China's past use of rare earth export cups, where tighter silver supplies could give Beijing pricing power and geopolitical leverage. According to the Silver Academy, the global silver market has been in deficit for several years, with an annual shortfall of over 2,500 tons. With reduced Chinese exports, the deficit could widen to more than 5,000 tons a year, potentially driving prices sharply higher. The squeeze is already visible. The Royal Mint of Canada and the US have reportedly run out of silver coins and bars, underscoring the tight physical market. Adding to the bullish narrative, JP Morgan has reportedly closed massive silver short positions on the CME, around 200 million ounces or about 6,750 tons between June and October. Over the same period, it is said to have accumulated roughly 750 million ounces or 23,437 tons of physical silver, signaling strong institutional conviction. India, which is one of the world's largest silver consumers, imported more than 2,600 tons of silver during September to October alone, with 1,715 tons arriving in just October. The UK and Hong Kong emerged as the biggest suppliers during this period, followed by Switzerland and the UAE. Market watchers suspect that some shipments routed via Hong Kong could be silver leased through the London bullion system and ultimately sourced from China. Brokerage ICICI Direct believes silver prices are likely to remain elevated amid China's export restrictions. The brokerage sees the development as positive for Hindustan Zinc, India's largest silver producer, which has a refining capacity of around 800 tons per annum. Silver contributed roughly 40% of the company's EBIT in FY25, and since it is a byproduct with minimal processing costs, higher prices directly boost profitability. However, citing rich valuations, ICICI Direct prefers exposure through promoter entity Vedanta rather than Hindustan Zinc directly. Silver has surged nearly 115% so far this year, outperforming gold's 64% rise and trailing only cobalt among major commodities. After touching $64 an ounce, prices recently hovered around $62. With a deepening physical deficit, strong green energy demand, geopolitical uncertainty, and now China's export curbs looming, market participants believe silver's supply crunch and its price rally could be far from over.